Hello, everyone, and welcome back to the podcast. I'm here today with Pack Ventures founder and general partner Ken Horenstein. Ken, welcome. It's great to have you here.
Thanks. I appreciate being here. This is going to be fun.
So you and I met a couple of months ago at a Keiretsu Forum event in the Seattle area put on by Future and Review Advisory Board member Nathan McDonald and his incredible wife, Brianna. They're an incredible entrepreneurial team. They bring together a lot of very interesting people in the venture kind of ecosystem. But I was particularly intrigued by what you're doing when we met, because you are running a fund that is adjacent to the University of Washington. Can you tell me a little bit more about Pack Ventures? Like, what is the one-liner and what is your investment theory?
Yeah, and thanks again for having me. So Pack is the official preferred venture partner at the University of Washington. And really what it boils down is UW is one of the best research institutions on the planet. When it comes to bioengineering, computer science, deep technologies, we're up there with every other household name you've heard of: Stanford, Harvard, MIT. But we've been historically overlooked when it comes to venture funding. So in 2021, we ranked about 19th on the list for university alma mater founders funded.
Oh, interesting.
We had about 70 founders get $1 million in funding or more. Stanford at the same year had 465. But we're getting $1.2 billion every year from the NIH, which is second only to Harvard. We have the second most invention disclosures every year on average. And so we've got all these inputs, all the talent, all the resources, but that hasn't transferred into funded founders. So Pack's whole focus and mission is backing founders that have some connection to the University of Washington ecosystem.
So why do you think that is? What is it about the Seattle ecosystem that is underfunded? I mean, and it's not just because there was no UW adjacent fund. I'm assuming there's something about the ecosystem generally that's making that more likely.
Yeah, I think part of it is cultural. So, we have billionaires in Seattle who still drive Subaru Outbacks, right? We just have this ethos of not really putting ourselves out there, self-promoting, talking about what we're doing. There was a TechCrunch article recently that talked about the biggest AI cities in the world. Mm-hmm. They didn't even mention Seattle. We have both Azure and AWS. Yeah. All of their engineering headquarters are right here.
Right.
So per capita, we have the most AI engineers of anywhere. And so I think it's been something, me and a bunch of people have started to focus on a lot more is how do we get more attention here? How do we get more dollars in? There's a great analysis done by the head of Founders Co-op, Chris DeVore. And what he looked at is, hey, we don't want to be Silicon Valley, right? That's not what the goal is here. The goal is understanding what is the financial return potential as a venture investor in each city, mm-hmm. and then how do you use that to focus your investment strategy? And what Chris was able to define, I think he used mostly PitchBook data, was that per
also a Seattle company, by the way.
Also a Seattle company, exactly. And John Gabbert, the founder, and until about a couple weeks ago, CEO of PitchBook, is a UW alum.
Okay, good.
And what Chris had found was for every dollar that goes in here, we actually have one of the highest, if not the highest, return ratio for VCs. So I think it's a little bit cultural. How do we just get the word out there a little bit more, share more about what we're doing? But the other aspect of this is a story that I share from my partner T, and she lives down in the Bay Area, has a ton of friends that are founders that went to Stanford or Cal. She shares this great story about Stanford alums, and what they'll say is, Sarah's sitting in her CS class, she looks to her left, and Chris has started a company. She looks to her right, Mohammed started a company, and she thinks, wait a minute, I keep getting better test scores than both of them.
Why don't I start a company?
Exactly.
Yeah.
We don't quite have that ethos at UW right now. And that's something we're also working on.
Okay, so I'm hearing a couple of different things from you. Number one is more of a focus, and culturally speaking, on entrepreneurship, founding companies, starting things. If you have an idea, turn it into a company, right? And number two is a lack of kind of general awareness or PR, I would say, of the Seattle tech scene and the strength of Seattle tech Seattle's tech ecosystem.
Yeah.
But the other thing that I've observed as someone who has fundraised and, been around the Seattle tech scene for quite a long time now is that there is a dearth of there historically, I will say, have not been as many investors in the Seattle area, and especially investors who are willing to take bigger risks. So 100%. To your point about companies tend to do better, I think the companies that tend to get funded in Seattle are often companies that are lower risk and that are much more B2B companies and are, because of that, there is a little bit more that I think that I'm just bringing this up because I think that plays into what you were talking about as well.
Yeah, I fully agree with you. So Seattle, if we look historically, was really based on 3 industries and their companies. The first major industry that actually drove most of the Seattle growth from the mid-1850s until probably the mid-1900s was logging.
Timber, yeah.
Yeah. And actually some of the wealthiest families in Seattle today are old timber families. And if you think about that, that's a very kind of linear growth. You have a certain number of inputs that give you a certain number of output. Mm-hmm. And then the next generation of that was really high tech. The first being Boeing, right? And so deep manufacturing expertise that still is here today. But then the last wave is probably the most interesting before the most modern age, which is Microsoft. And so from Microsoft, we actually saw a massive flood of early stage risk capital come into the market because overnight, in about 10 years, we had thousands of millionaires, right? The Microsoft millionaire crew.
Right.
And those folks ended up founding the original kind of angel investment groups of the region, right? Yeah. The Alliance of Angels.
Many of them are still around.
Many of them are still around. Many of them are still investing. However, a lot of those that are still around, they bring a very Microsoft late 80s, early 90s style approach, which was a very risk-off approach, right? Mm-hmm. And so what we end up happening here is really smart founders that are oftentimes kind of optimizing for not losing, as opposed to in the Valley, you might see people who are optimizing for the biggest win possible.
Right.
And that comes in with the investors as well. So I'm actually a huge proponent of us getting outside capital to the region, right? We could probably have 4, 5, 6x the amount of capital here that we currently have and still have a better return ratio than somewhere like Silicon Valley. The other couple things I'll point here is we have not seen, so it went, Timber, Boeing, Microsoft, and now the current wave is Amazon, Zillow, cloud,
software,
right?
data.
Absolutely. Yeah. AI, big data. We haven't seen the same proliferation of investors coming out of Amazon. Like I kind of commiserate with angel investors all the time here about how there's probably somewhere between 50,000 and 100,000 accredited investors just at Amazon.
Who don't realize that they're accredited or just aren't interested?
Not interested. Okay. That's the opportunity for us. So, I've talked to a few LPs coming out of Amazon, and their calculus is very different than other LPs. Their calculus is, I'm going to have to sell some Amazon shares to be able to invest in this fund. And I've been getting about 30% a year on my Amazon shares. So why would I do that?
Interesting.
VC is not just about the IRR, right? Yeah. It's also about the impact that you can have on an industry or the world. The second part of this is really important. The rise of, I don't know what we're calling them now. I think it's Mang. We used to call them Fang. But these top 7 companies, right? 2 of the biggest are right here in Seattle. Over the last 20 years, the salaries and total compensation for those companies has gone through the roof, right? Top AI engineers are making low 7 figures at these companies. You are never going to get paid that as a salary as a startup founder. And so as these companies grew, they built what we lovingly call golden handcuffs. So actually, before I founded PAC, I helped co-found a community and an accelerator that was all about trying to break those golden handcuffs and helping these incredible data engineers, software engineers, even the go-to-market and business folks recognize that being a founder isn't just about eventually building $1 billion company. It's about having the autonomy to build the type of company that you want, to hire the type of people that you want, to change an industry the way that you want to. And so that's one of those cultural things where if I'm having a conversation with a founder and they're saying, well, how am I going to continue to make $500,000 or $750,000 a year as a pre-seed founder?
You're not.
It's not the fix. No. Yeah. It's like,
in fact, people will not invest in your company if you try to pay yourself, anywhere near that.
But, I think maybe one of the positives for Seattle is COVID broke this a little bit. The first thing it did is it gave people the opportunity to go work remotely and explore a life that was not 50, 60, 70, 80 hours a week inside the office. That was the first thing.
Yeah.
And then the second thing was with the rise of interest rates and all of these big tech companies tightening their belts, everyone realized that these weren't golden handcuffs anymore, right? They could be broken at any time by the company themselves.
Right.
So now we've got people coming to us saying, you know what? I've been at Amazon for 10 years. I've built some really great skills. I don't trust that I'm going to be here for another 10 years. This doesn't feel like guaranteed job, guaranteed compensation anymore. And I've been thinking about this idea for years. And so now it feels like the time that I'm willing to take more risk, take a lower salary, but build the thing I want to build.
So you're saying that recent tech layoffs have actually incentivized people to the entrepreneurial space further. Do you think that's true beyond Seattle?
Yes.
Okay.
100%.
Yeah.
I think that's just been a cultural shift in tech generally, where people thought, oh, this is no longer a free ticket to being a 5 or 10 millionaire.
The other thing that I think is very interesting about this moment when it comes to entrepreneurialism is everyone is talking about LLMs and their capacity, and their fear of the jobs that they might replace or that they are replacing, which is happening. You no longer need to hire as many developers as you used to, right? And a lot of those entry-level jobs are starting to be replaced. But one of the things, the positive potential externalities that I see is that they do open up the capacity for someone who is not a developer, for example, to be a founder and to make that feasible for someone who is non-technical but has a great idea and maybe can help really manage the execution and hold that vision in a way that has not been possible before. Are you seeing that happen yet? Or I'm just curious what as far as companies coming to you.
Yeah. So there's two points I would make on this, because I think this is the absolute right question to be asking right now. And I think it's the question we as a society and as a country and as a global community are going to be asking probably for 5 or 10 years.
Yeah.
So two big things here. The first is, one, I'm totally biased. I'm a techno optimist. So when I look at a moment like this,
I'm kind of in the middle. I see both. I see both. I'm like, okay, I talk to a lot of people. I get to see all the negatives and all the positives.
Then you can push back on me here. But, they say history doesn't repeat itself, but it rhymes. And so I look back at other technological explosions that have happened, and I see what happened to employment rates, what happened to jobs, right? I think this means there will be a shift in jobs, but I think there will be more work to be done. So I'll give you an example here. Our fund is a generalist fund, about 40% software, 40% life sciences, 20% deep tech. We tell people we do everything from consumer internet to space tow trucks, which is a real company we've invested in. One of our companies, in an area that we focus on very heavily, is this convergence of AI and biotech. How can you leverage computer software to go faster and further before you have to go into the wet lab and start to prove out whether a molecule, a protein, or whatever you're building actually works? One of our portfolio companies was working with one of the big 5 pharma companies. And the big 5 pharma said, hey, we've got this huge trove of data. Can you use your algorithms to help us focus our efforts on further development? And so the company did this over, it was roughly 6 months, I believe, came back and said, okay, we did that part. Let's sign another contract. And the big pharma company looked at them and said, actually, you did such a good job. We now have 2+ years of wet lab work that humans are going to have to do. And so we don't need to sign another contract right now because you got through so much of our data so fast. And so that's the opposite. They actually created 2 years worth of work for lab scientists that did not exist before. So I think that's a huge part of it.
And in so doing, talk themselves out of the next phase of their contract.
Yeah, I mean, we'll mitigate it other ways, but as it proved the value of the software.
Yes, definitely, right? Yeah.
But your second part of your question is really great, which is, okay, how do you build a company today, or what's different now before, the release of ChatGPT? Before, we had very clear amounts of money that needed to be invested to reach certain milestones in a company's life, whether this was technical milestones or revenue milestones. Right now, that amount of money is somewhere between 20 and 30% of what it used to be. So we're talking about a 75 to 80% reduction in the amount of money to get to the same milestones you would have gotten to before.
Okay. And is like, why? Like, talk us through that.
Copilot and GitHub or Devin or any of these developer assistant tools means that they need to hire half the number of developers.
So it's primarily the developer part of it.
Primarily the developer. Mm-hmm. What we're about to see unlocked, which I'm a little bit scared of, is we're seeing all of these new companies come in that are working on the leveraging AI on the workflow side of customer acquisition. So how do we go out and actually more efficiently win contracts, bring new customers on board, get them time to value lower? So, right, I sell you a piece of software. It might be a 3-month integration or a year-long process until you see the real value out of it.
Right.
Even that is coming down. And so now you can sell to more people. You can sell more efficiently. So you're hitting both the development side of things is coming down drastically, and the go-to-market acquisition customer growth side is becoming more efficient. So those kind of two things converging, all of a sudden we have a company we're talking to that's talking about raising $5 million to get to a $5 million run rate. That in the past would have taken $20 to $40 million to get to. And we're talking about a fourth or an eighth of the capital they would have needed previously to get to that same milestone.
And what are the tools that so this is very interesting, right? Because growth is always a challenge for every company. And it has historically been the thing that was like make or break. Do you get your next round of funding? Is like, can you hit the hockey stick?
Yeah.
What are the tools that you're seeing that are most useful for companies in shortening it?
So I won't give you specific names because there's usually multiple companies in this space. So I don't necessarily want to king make one. But we're seeing multiple companies in the content creation space, which will engage and educate a potential customer much more efficiently. We're seeing multiple companies in the sales customization space. So how do I have the right message, the right data assets, the right product for this particular customer? We're seeing just back-end operational tools. So instead of you having to spend as a seller, 1 day out of 5 a week doing all of your process update, updating your deal flow pipeline, sending out reminder emails to customers. What if we just use agents to automate a bunch of that?
Right.
And so, every part of that customer acquisition, process, there's 5, 10, 15, 20 companies tackling it. The bigger question is, will any of them survive?
Yeah. Or which ones will survive?
Or which ones?
Yeah.
Yeah.
That's why I think you overestimate the value of this particular podcast to be a kingmaker of AI services. But that's why I was curious to know specifically what are people finding the most useful? I do kind of want to know, we have a lot of entrepreneurs that listen to our podcast, right? So if you were to put together a toolkit for entrepreneurs, maybe we can talk later if you're not willing to answer that question.
I'll share a few. I'm just thinking the ones I got to disclose because we're an investor, so it might be better. So one of our companies is now kind of pivoting their product to be focused solely on growth. The company is called LifeAt.
Okay.
If you go to their website today, they build these beautiful, very serene workplace kind of scenarios. So you can have on your second monitor a gorgeous background landscape with music that'll meet the tempo of your work style and things that help you focus and be a much more productive remote worker.
Okay.
But they've grown this into millions of users, and they have hundreds of thousands of followers on their social channels. And so they've now taken their process of building their company and just said, we're going to turn that into code. So you'll be able to use LifeAt to optimize all of your social outreach and content to meet the exact type of customer profile that you want, using micro influencers who are relevant to your particular industry.
Got it.
That would have been taking an entire talent agency,
Yes.
Hours of booking meetings, and now they're doing it in minutes. Kind of thing.
As someone who runs a pair of small media companies, I could use that tool, right? Like,
100%.
Absolutely.
Another one, we actually did not invest in this one, but I really like the founder, and it's a really great idea. It's called Meeting Flow. And so what this is going to do is, rather than you going out and doing a bunch of sales research and trying to understand the exact customer you're coming into a meeting with, it uses a bunch of AI agents to go out and collect all of that information, build you a pre-read document before your meeting. Right. And then during the meeting, you can plug into your Zoom recorder, your read.ai recorder, whatever meeting recorder you want. It will take those action items and it will start to draft follow-up emails for you to just immediately execute on.
Yeah, so that's a good one. Like these are the things where it's like things that people need to do, but don't really want to do. This is where I think LLMs are like very exciting. Like if I can replace emailing a million people every week, it's going to be.
Who wants to update their CRM?
Right.
It is literally the bane of my existence every week.
And yet it is so important. Yeah.
And so, those are the things that we're starting to see that are coming in and starting to help on that kind of go-to-market sales enablement side of things.
Okay, so let's talk more about this is the first fund that you've founded personally.
Correct.
But you were previously at M12, which is Microsoft's venture fund before this. What was your work like there, and what did you learn about Microsoft's investment thesis that has informed your work today?
Yeah, before I got to PAC, when we're actually raising our second fund right now, so we're a little bit further into it than just the first fund. But I spent 3 years at the M12 team before it was actually called M12. I think I was the 11th or 12th person to join the team. And this was like my master's degree in venture capital. It was so cool to be a part of. We were investing in roughly 20 new companies every single year, predominantly at the Series A, but we would go down to the seed and up to Series C. We would write checks between $2 and $10 million at a time. We had a global team, so we were covering India, all over North America, the UK, all of the EU, and Israel. Wow. And so we did a back of the envelope kind of sketch of how many companies has our team met with over a year. And it was something like 5,000 to 8,000 companies a year that we would meet with as a team, or see a pitch deck and an email or whatever it was, to only invest in about 20 of them.
Oh my gosh.
But, there was a couple really core design principles of what we were doing. CVC is on a scale. So on one side of the scale, you have something like a Salesforce Ventures, which is like, hey, we're going to invest in you, but primarily because we want you in our ecosystem and we want you to build on the Salesforce platform.
And we might want to acquire you in a few years.
And we want
to make sure we keep tabs on what you're doing. Yeah.
And then on the far other side of the spectrum was a Sapphire Ventures, which is independent from, but SAP is their largest LP, a Google Ventures, a Gradient, and then we were closer to this side with M12. And so what that means is we were looking for market signal. It didn't matter what Microsoft was doing, right? We might even intentionally make a bet against Microsoft's approach because we were investing alongside Kleiner Perkins or Sequoia or Andreessen, and there was a general venture community, consensus that the technology was going to go direction A, even if Microsoft or the big technology companies thought it would go direction B. And so that kind of freedom only comes from having the just absolute 100% support of Satya and his executive team, right? And Satya saying, hey, Nagraj Kashyap, who was our kind of head of the venture fund, and Peggy, who was the head of business development at Microsoft, I completely trust you. Just go find me insights and things happening, and I will learn, right?
So you were looking for companies that were profitable in ways that maybe were unexpected, it sounds like, and also companies that could be strategically important to Microsoft in the future, even if they were the opposite of.
Yeah, I would say profitable wasn't as important. So
Okay.
we were still investing at the bottom of the J curve, right? So these companies were still losing a lot of money.
Sorry, I said profitable. What I meant to say was I should have been. Of course, we do not associate in the venture field profit and success all the time. What I meant to say was, like as you put it, customer, like there's some kind of like signal of interest, right? Market signal.
Yeah. There was some type of traction or some type of pull for what they were trying to do.
Yeah.
So when you're investing in the Series A, that's usually a company that's got 1 to 3 million in revenue. But we see a path to well north of 100 million in annually recurring revenue. So one, we wanted them to be industry leaders if we were going to back them. And I got to go back and look, but I think during my time there, the team in total backed what ended up becoming like 6 or 7 unicorns from the Series A realm, right? So we're talking 30 to $50 million valuations going up to above $1 billion, right? So that was paramount for us. We were financially motivated. We wanted to see 20x returns if we could get them out of a company. But on the other side of it, you're right. There was strategic benefit for Microsoft. I remember talking to one of the leaders of Microsoft, and they made this comment that was, okay, we put $5 million into this company, and the discussion I just had with that founder and that team would have taken me $100 million and 18 months and 100 engineers to get that level of insight.
Yeah.
And so this, whether we make money or not, this is already a benefit for us. The other thing I want to highlight is, one, part of my role was meeting with Fortune 100 and 500 CXOs to share our whole investment process and theses, right? And say, hey, here's how you can do this well at your company. And so as Microsoft, access to those types of customers would lead to a transformational customer moment for our portfolio. So the portfolios were getting massive benefit by taking our investment and working with us, right? And so it was a very fair exchange where, in my opinion, and M12 has changed quite a bit from my understanding, but it was, if we go from a lens of we're trying to make financial returns, that increases the likelihood that a top tier venture fund will want to work with us, which then increases the likelihood we get into the best deals, which then increases the quality of strategic insights we provide back to Microsoft. And so it had this very kind of beneficial flywheel between investing and strategic insights.
So how does that apply to PAC? Like I have a feeling there's some similarities in, I'm hearing some similarities in between like what you're doing now and that specific strategy.
Yeah. So a big focus for us with PAC is our community engagement to be able to asymmetrically help make our companies successful. So when you think about Stanford or MIT, one of the big things you think about is the fact they give the access they give you to their alumni network.
Right.
UW has over 550,000 alums across the world in every industry, every product type, every technology. And so with PAC, we've actually intentionally built a really big LP list. So we have over 100 LPs in the fund right now. My ideal number is over 250. And
that's a lot of people in your CRM, Ken.
Oh, the CRM is a couple thousand. Yeah. And the point of that is I want to not only write a $500,000 or $750,000 check, I want to also be able to immediately introduce that founder to someone in our network who can change the trajectory of their company.
Right.
Whether it's a customer, an advisor, a mentor, a board member. And so the idea for us is taking a lot of what we built at M12. So half of the team at M12 was investing, and half the team is talking about doing what I'm talking about, which is all value add services. How do we do that inside of the University of Washington network? And so those learnings were huge for me. And then I think the other big thing is just thinking through a portfolio strategy. How do you understand the types of founders to back? Mm-hmm. We'll back 35 plus founders from our next fund. And how do you think about the opportunity of not just that one company, but that one company in a portfolio of 35 others, right? And make intelligent capital and asset allocation decisions based on the risk reward profile of each of those companies at different stages.
So let's talk more about that. What are you looking for? Like what are the green lights for you when you're looking at companies?
Yeah. Number one, so we're pre-seed and seed. Mm-hmm. So a lot of the companies we're talking to are an idea and a pitch deck and not much more.
Still a lot of risk.
Still a lot of risk. Which means,
yeah, go ahead.
Ideally, there's a 50 to 100x return potential in the company. Okay. So if we get involved at 5 or 10 or $20 million, we want that to be a 250, 500 million, billion plus dollar company when it's all said and done. But that's actually probably the second consideration for us. Number one is companies are built by people. And so who are the people that we're going to spend the next 10 years working with? And specifically for me, this was actually also a big takeaway for me from Microsoft, is finding founders who are in a growth mindset. Mm-hmm. So there's a couple questions I like to ask people. And what I'm listening for is when a founder says, I know this to be true, or this is the way it is, and they don't immediately follow it up with data and process of how they came to the conclusion, they're probably not going to be a fit for me. Because the only thing I can guarantee you is the company that they're pitching me today is not the company it's going to be in 2 years.
Right. And there's such a strong need to adapt and pivot and change and adjust.
100%.
This is something that I kind of struggle with, even within teams that I work with, right? It's like, how do you help people as a leader? How do you create that mindset and that sense of possibility in others? Because so often in society, people are trained to see doors, right?
Yes.
And you're looking for people who actually are trained to see, or they're trained to see a wall, and you're looking for people who can see the door and can open the door and walk through it and find like the opportunity in challenge and the opportunity in hardship. Because as an entrepreneur, we all know it's very hard.
Yeah. For me, at this point in my career, what this boils down to is someone who's curious. Mm-hmm. How do I, one, test for curiosity, and two, enable curiosity? The enabling side typically means not just answering the question for them. It's about my time investing in being a better question asker. Something that will make them think about the problem, have to step away from me and the problem, and then re-engage with trying to learn or figure it out. And so it's oftentimes communicating to them in that way. So instead of saying, hey, will you do it this way? Or no, that's not right, you got to do it this other way. Mm-hmm. It's asking them a question, right? Hey, if we took this to its end state, as far as we could, what would we get to? What would the answer be? Wait a minute, I never thought about this problem or this situation that way.
Yeah.
Let me think about that and let me start. I'm a huge fan of mental models. I read a lot of Charlie Munger. I read a lot of Jeff Bezos's letters, Naval Ravikant. And so one that I love from Jeff is starting with the end in mind.
Right.
Right. And so at Amazon, what they do is they write what's called a PR FAQ. Mm-hmm. The day we launch this product, what is everything that's happened and everything we want the world to know about it? Okay. It's going to take us 2 years to get there. Let's now backfill the rest of the development plan. And so to me, if I can ask a founder questions, so the other way I do this is I will intentionally take the other side of whatever their claim is. Even if I don't believe the other side, I might be fully on board with what they're saying. and push on them to see if they respond in a couple different ways. No, that's not right. You're wrong.
Mm-hmm.
Okay, that's a sign for me.
Mm-hmm.
Oh, that's interesting. I haven't thought about it. Let's talk about it out loud. Okay, that's a sign for me. Or I thought about it, and here's the reasons why we're not going to go that direction.
Yeah.
Also an interesting sign for me. The last two are founders I would probably like to back. The first one, not so much.
Yeah.
Yeah. And then kind of the last thing, because the original question is like, what do you guys focus on? So tons of artificial intelligence. 63% of our portfolio across every technology sector in Fund 1 had artificial intelligence. We do a lot of B2B and enterprise software when it comes to software, a little bit of consumer, but not as much. And then in the life sciences, we do a lot of this convergence of AI and biotechnology.
Right, which is a huge area right now.
Exploding.
Yeah.
And we benefit from arguably top 2 person in the world for this is located on UW's campus. So everyone knows Mistral, Llama, OpenAI on the software side, right? On the life sciences side, there's 2 generative models. One is called AlphaFold, and it was built by DeepMind at Google. And the other is called RosettaFold, and it was built by David Baker at the Institute for Protein Design on campus at the University of Washington. And so we focus a lot of our efforts in that lab as well. How can we use artificial intelligence to build new biologic drugs, new clean materials, new manufacturing processes that are bio-based? And so that's a huge focus for us when it comes to life sciences.
So let's talk about your LPs for a minute. And not specifically your LPs. I'm not going to ask you to tell me any distinguishing characteristics about them. But you have, so I apologize earlier. I said when you had founded your first fund, what I meant to say was like the PAC in general. So PAC as a company, you are now on your second fund, but within PAC. You've had some time to kind of get to know some of the LPs that you're working with, and you've had, I would imagine, a lot of conversations with different LPs of all different types.
Yeah.
What are trends that you're seeing in the LP community? And I'm asking this question in the context of the last few years have been really tough for a lot of VCs, given interest rates. There's been a lot of VCs that, are not going to make it, or have gone out of business. I'm just curious what you're seeing developing as like new emerging trends.
Yeah. I want to start with a data point on something you just said. So PitchBook did an analysis like at the end of last year to say what's going on in the VC fund market. And it was over 30% of venture funds have essentially stopped writing checks, which means they're pretty much out of business.
Right.
30%.
Or they're holding. Like they don't have.
Correct.
A lot of them actually pulled their money back and said, we're not going to write any checks because we're trying to.
Well, that's a different problem. Yeah. What I'm talking about are people who are just net saying, we are not going to invest in any more companies. We are going to manage the companies we already invested in.
Right.
This, as a fund, essentially is no more. Because as a fund, it's all about doing new company investments, right? The largest of this was OpenView, which was a multi-billion-dollar fund who just all of a sudden announced, you know what, we're done. We're not going to raise any more funds. And so we're seeing this almost like mass extinction event of VCs, where we're going from 7,000-ish firms down to something more like 3,500, 4,000 firms.
It feels sorry, I don't mean to interrupt you, but it does feel like it's very aligned with what's going on in the corporate ecosystem, right? Like there's a lot of kind of like trimming. I think there was a lot of overinvestment in workforce, and there was a lot of inflation of workforce, and now we're seeing that kind of trimming back of that, especially at major tech companies. And what you're describing sounds like the VC equivalent. It's not that different from what we're seeing at the Mangs of the world. Yeah.
And that's because money isn't free anymore, right? We are in the cycle, well, depending on what the Fed does in the next couple of months, where we're potentially sucking out a bunch of money, right? The other data point on this is historically funds like mine, I'm called an emerging manager. For some reason in venture, until you cross fund 3, you're just still kind of an emerging manager. Historically, the graduation rate from fund 1 to fund 2, so the ability to raise a second fund, was 60 to 70%. Last year, that dropped to 12.4.
Okay. And what's your, well, you clearly raised a second, you're in the middle of raising a second fund.
Yeah, but we've already done a close.
Okay.
So I think there's a transformation happening in VC where the last couple of years we had almost like VC tourists. So these were folks who were great product managers, great engineers. Their friends were starting companies, so they had a little bit of access to deals. And so they started an angelless rolling fund or a small little fund. But when everything is going up into the right, VC looks pretty easy, right? Oh, you just put in some money into your friend's company and someone else marks it up. But these last 2 years, barely anything has gone up into the right. And so, you know, now we're back, at least on our end, working 60, 70, 80 hours a week, getting like in the weeds with our founders. And if you're a full-time engineer at a different firm, you can't do that. So I think we're maybe going to stabilize back towards the true professional, institutionalized VCs who are thinking about this in 10-year life cycles and over a 30 or 50-year period. Those will probably be the ones that continue to stick around, right? How does this impact LPs?
Yeah.
So I think LPs have a ton of capital sitting on the sidelines right now, right? We have a very diverse LP group. So we have folks who I just consider generally high net worth folks. They could be an engineer at a big tech company, or they could have sold a company and have a few $1 million. Then we have our kind of like family office groups, right? These are folks with $100 to $1 billion under management who are very intentional about finding venture funds. And then there's institutional VCs. All of them are getting smarter. And all of them are trying to understand what their VC partner that they're investing in, what kind of edge they have. So I recently participated in this kind of like YC for emerging managers. And there was about 25 of us that pitched at Demo Day. 20 of the 25 were, I'm an AI, SaaS, pre-seed and seed fund. How is an LP who's looking at 25, products, which are funds to invest in, supposed to distinguish who's the best to invest in? There was like 5 of us who had some weird niche focus area where it's like, no, we just want to own this one thing. I don't need to be in every AI SaaS company across the planet. I want to be in the top 5% of the best deals out of UW.
Yeah.
By the way, if you'd done that 10 years ago, it would have been $30 billion in exit valuations. That's plenty. We can produce venture scale returns. So I think LPs are getting smarter to this. It's not everything up into the right. They want to be much more thoughtful about where do I have asset allocation and how does each manager that I'm with differ from the other managers?
Are they growing more sensitive to the oversaturation of LLMs?
I don't get those questions as much from the LPs, but I am getting more sensitive, right? I would say somewhere between 1 in 10 and 1 in 20 AI startups that I see actually has some type of novel AI tech.
I was in a conference recently with I think it was a VC panel. There was a VC talking about this, and they were saying, we actually don't even invest in AI companies anymore. We're primarily focused on the data companies because the biggest challenge for those AI companies is the data, like having clean and organized and useful data. And there are a couple of kind of leaders in that space that are really feeding the entire industry. So they're going like downstream of the LLMs even, which I thought was pretty entertaining.
Yeah, I know you have a lot of founders that listen to this. So I'll give you one of my kind of questions that helps me determine if this is a real AI company or a wrapper or a novice, right? So most AI companies come to me and they pitch me on this proprietary data set that only they have access to. The number of synthetic data companies that I've seen in the last year that are going to absolutely destroy that moat, like that's not enough. That's necessary. It's not sufficient, right? So the question I typically ask people is, how are you thinking about reinforcement learning through human feedback, or for simplicity, RLHF? And what is really hard to fake is a product interaction. When someone interacts with your AI and corrects it and tells it to do something else, that is really hard to fake. And it's really hard to catch up to because it grows exponentially with your users, right? Because every user could potentially give you hundreds or thousands of pieces of data. And so the really good AI founders that I'm talking to are like, yeah, we're starting with this proprietary piece of data. We could be using our own or off-the-shelf AI models, but here's how we're going to fine-tune those in a way that gives us an edge. But then let me tell you how the product will evolve and develop in an intelligent way that will be hard for anyone to catch up with.
Right.
Almost no one says that third part.
And I think the part that you're saying there that's interesting and that doesn't get talked about enough is how do you obtain new data, right?
Yes.
Through your customer interactions, and how do you build that? Like, it takes a very kind of nuanced approach to your specific problem and the categorization of different customer interactions to capture that well.
100% right. So if you think about AI as how much value is being delivered, the first is acquisition of data. The second is summation or collation of the data. The third is insight production. And then the fourth is integration into workflows. These first three are getting commoditized faster than you can believe. We were meeting with two companies in the same space who had built something that could not have been built 18 months ago. What they were doing, consulting firms would have charged $250,000 to $500,000 for, and it took the firms 6 months to do. And these folks could charge $1,000 and do it in an hour. Okay.
If you're wondering why you're seeing a lot of layoffs at Accenture and Deloitte.
Yes, totally.
Yeah.
But so we ended up passing on both these companies. I was doing a poster tour in the electrical chemical engineering or the electrical computer engineering department, like grad, capstone event this last week. And a grad student built the same thing as these companies.
Wow.
As a side project.
Yeah.
Something you could not do 18 months ago, you now have someone who's never worked a day in the industry build something the same. It's just like mind-blowing how quickly it's evolving.
Well, Ken, this is about all the time that we have time for, but I am so excited to watch what you do with PAC and to see the companies that come out of your fund. And I'm also just like very excited about the future of entrepreneurship and innovation that we've been discussing today. I think it's, there's a lot of concern about economic impacts of AI and LLMs, but there's also a lot of interesting potential for upsides or new things that are going to come out of that. And I really appreciate the way that you think about that. It's been really fun talking to you about all of that.
Right, I appreciate it. Thank you for having me on. And looking forward to continuing the conversation.